Good afternoon, class. We are going to be working an exercise together. So I'm going to be working in Connect, but also in Excel, because part of this we'll have to do some calculations. So get Connect pulled up here, and this is Chapter 17, exercise. So we're first have some transactions we're going to need to do some journal entries for. And so January 5th through the 31st here, so we'll go through those. And then we need to compute the balance in the cost of goods sold account at January 31, and then determine the company's inventory balances and figuring out what our overhead looked like. Was it over-applied or under-applied? Because remember, it's very hard to get on the dollar with your overhead. There's an art and a science to it, and frankly, it's difficult to do. Okay, so first, we're going to record the purchase of materials on account on January 5th. So, where does that go? If we purchase materials until we use it up, that is materials inventory. So, we purchased it on account. So, start with our debit. This is why we make you take financial first. An inventory account, to increase it, is a debit entry. So our credit account, remember we purchased materials on account, so that means that we have a liability, therefore accounts payable, 800,000 in our, see if I got enough zeros there, yep, in our credit entry. Okay, so we're going to record that one. Now, we want the entry for direct materials. On job number 1001, we used materials costing $450,000. So remember, managerial accounting in this chapter is all about the transfer of costs. Okay? So if we use those materials up, job number 1001, that job is being worked on. Okay? Therefore, those costs are moving from that inventory account into work in process inventory. Job number 1001 is being worked on, so it counts in our work in process inventory. So we used materials, so that came out of the stuff we just purchased, materials inventory. So we have to take those costs out of inventory. Taking them out of inventory, moving them into work in process inventory, moving those costs around. So we used, on January 14th, used materials costing $200,000 on job number 1002. Same thing. Okay, moving those costs around. So work in process inventory gets those $200,000 in costs. Extra zero on there, sorry. From the direct materials inventory, again. So credit takes it out. Okay. Got that one taken care of. January 18th, use materials costing $100,000 on job number 1003. Nothing different there. So these three jobs are in our work in process inventory. So those costs are moving out of the inventory account into the work in process inventory account. Those materials, we don't have them anymore. They've been put into play. Okay? So we have taken care of our jobs. Okay, as far as direct materials. So now it looks like we're going to apply some direct labor costs. 1001 gets $3,600, 1002 gets $5,400, and 1003 gets $1,350. Direct labor hour workers earn $18 per hour. Okay, so we can do this in a compound entry. So since we know all three of those jobs are in work in process, we can get our calculator out, add 3,600 plus 5,400 plus 1,350, and we get $10,350. Okay. So work in process inventory still gets those costs. Okay, these are just, it's direct labor instead of materials. So all three costs, our production costs, are capitalized. Direct materials, direct labor, and overhead. Okay, this came out of this cost stemmed from direct labor. So $10,350 comes out of our direct labor account into work in process. Okay, so again, all we did was add those costs together, because from January, these three entries, we know that 1001, 1002, and 1003 has to be in work in process. So their related labor costs go in there as well. Okay. All right, January 27th. We're going to apply manufacturing overhead to all jobs at a rate of $450 per direct labor hour. Okay, so we have a little work to do here. So we know that our workers earn $18 per hour. So let's go ahead and pull Excel up here. And then move back to Connect. And we know that job number one, the 1001, had $3,600 in direct labor costs. Okay. So that tells us we had a total of $3,600 if our workers made $18 per hour. That tells us that should not be a dollar sign. Let's take that off there. Nope. Let's see. Sorry, I'm having let's do this. Actually, let's make this a little cleaner. So we know job number one was 3,600 hours. And I want to take those decimals off because that is not currency and we don't need any decimals. I just put it back there. So hopefully you're laughing at me right now because I haven't done Excel in a while, so I need to take this dollar sign off. So hold on just a second. Let me format this. We just want that general. There we go. Okay. Hang with your poor professor here. Okay, so we know that job number 1001 had $3,600 in labor costs. So if we take 3,600, divide by how much our workers made, we know that they worked 200 hours for us. Okay. Now the reason we care about that is because we apply overhead per direct labor hour. So having the costs tells it's half of the battle. But we need to know how many total hours those employees worked for us in order to apply overhead. So let's go do that for job number 1002. So 5,400 in direct labor costs there. If we divide, now we know that job number 1002 used 300 hours. Okay, so let's work for job number 1003, $1,350 in direct labor costs. So dividing our costs by our wage per hour. Our workers worked 75 hours for us on job number 1003. So adding all those together, we know that we had 575 total labor hours. So we apply overhead based on $450 per direct labor hour. So we know we had 575 total labor hours. So if we multiply that by $450 per direct labor hour, we know that we had 258,750, okay, in overhead. So this is our applied overhead. Let's go ahead and make that a number. Get rid of those pesky decimals. Okay. Okay. So now we know what we applied for overhead. So remember, that's our budgeted number based on our predetermined overhead rate. Okay, that $450 per direct labor hour is our predetermined overhead rate. So for our journal entry on January 27th, we need to go ahead and apply that cost. So again, work in process inventory is where those costs are going to end up. Okay. And we're going to take those costs out of manufacturing overhead. Okay. So record that entry. So the last part, our January 28th, was going to complete and transfer job number 1001 and job number 1002 to the finished goods warehouse. Okay. So those costs that we put into work in process, those jobs are no longer being worked on, so we're going to move those costs into finished goods. Okay, so for 1001 and 1002, we need to know what their costs were. Make Excel just kind of my scratch paper here. All right, so job 1001, the amount of overhead we would have applied, we had 200 hours, remember, so equal sign first, 200 hours times $450 per direct labor hour. So we had 90,000 in overhead. Okay, actually let me title these, that might make a little more sense. Okay, so these are overhead. We need to know what our direct labor costs were for this jobs and our direct materials. Okay. So we know labor for or overhead for 1001. For 1002, we had 300 hours. At $450 per direct labor hour. So that's $135,000. So now our direct labor, we already have those, so we had $3,600 in direct labor costs for 1001 and $5,400 in direct labor costs for 1002. And then direct materials, we go back and look. So if we look at the January 9th transaction, so going back, used materials costing $450,000 there. And then for 1002, used materials costing $200,000 there. Okay. So now, adding everybody up here, for job number 1001, we had $543,600 in costs, in production costs, and for job number 1002, $340,400. So, adding those together, we're at $884,000 for the two jobs. So we go back into our journal entries. So since we're completing and transferring those two jobs, those are going into, costs are going into finished goods inventory. Total of $884,000. And then our work in process inventory, remember these are coming out of work in process. So we're taking them out of that inventory. Therefore, credit, that has to be our credit account. Okay. So now we have transferred jobs number 1001, 1002 out of work in process into finished goods. Okay. So now we're going to sell job number 1001 on account for $725,000. So those costs are being transferred out of finished goods, and remember, we close finished goods once we sell them. Those costs close to cost of goods sold. So, and actually Connect is probably going to have you do this in two pieces. So let's record the sale first. So scratch that entry. So since this is coming out of our finished goods inventory, but we're selling it out of, selling it on account, let's do this first. So accounts receivable, we sold it on account for $725,000. And that is sales revenue. Okay. So we've recorded the sale. Now we record the cost of job number 1001. So now we record cost of goods sold. We want to record that sale first. So we recorded and paid. Actually, we're still on January 29th, sorry. So since we sold it, so we recorded the sale, now we need to record cost of goods sold. So 1001, we go back and look at our Excel spreadsheet, cost us $543,600. So now, that's our cost of goods sold for job number 1001. And again, 1001 is coming out of finished goods inventory. So we've transferred those costs, those production costs, direct materials, direct labor, and overhead for 1001 out of finished goods inventory into cost of goods sold. Okay. So when you sell an item, you're going to have two entries. First, you're going to record the sale, and then second, you're going to record cost of goods sold and moving those costs around. All right, so January 31st, we're going to record and pay actual January manufacturing overhead costs of $250,000 in cash. Okay, so manufacturing overhead is getting some costs. So we've recognized that we incurred those manufacturing overhead costs and we paid them in cash. Okay. So now, since we have actual costs, we need to close the manufacturing overhead account directly to cost of goods sold. Well, that tells us exactly which accounts we're dealing with. So the thing is, you need to decide which way it needs to go. Is it over-applied overhead or under-applied overhead? So remember, our cost of goods sold, unadjusted, if we go look, when we did added these two together, 543,600 and 340,400, we got our total. Okay. And so that together, so our cost of goods sold, unadjusted, we only sold one of them. So we would have had, let's set it up this way. Would have had the cost of job, so cost of goods sold would have had the production costs of job number 1001, so 543,600. Okay. So what we need to know is how much we should have applied. Okay. So our manufacturing overhead applied to jobs would have totaled $258,750. Our actual overhead. So if we need to add 1,003 in here just to clarify where we're getting some of these numbers. So we're calculating the overhead for 1,003. We knew it for 1,001 and 1,002, but not 1,003. So we had 75 hours direct labor hours. Remember, our multiplier is $450 per direct labor hour. Okay, so we would have had $33,750 in overhead costs for 1,003. So now, when we add them together, we know how much we would have applied to our overhead account for those three jobs. $258,750. Okay. So that's how much overhead we applied to jobs. So going back and looking, we incurred actual overhead costs of $250,000. That's how much we actually applied. So the difference between those two now you have to decide if that's over applied or under applied. I applied $258,750. My actual costs were $250,000. That was given. So the difference has to be over applied overhead. So that $87.50 is over applied. So remember what that's going to do to our cost of goods sold. Over applied overhead decreases cost of goods sold. Because we anticipated spending $258,750, but we only spent $250,000. So this is going to decrease our cost of goods sold. Okay? So job number 1,001 sold, that's our cost of goods sold. We subtract over applied overhead because that's going to decrease. So we subtract that $8,750 in over applied. And that tells us what our overhead adjusted cost of goods sold account adjusted for that over applied overhead should be. So $534,850. So now that we know that, we can go ahead and make that adjusting entry to our cost of goods sold account. So manufacturing overhead decreases by $87.50. In our cost of goods sold account, so our manufacturing overhead needs to be increased by $87.50 because we didn't incur that much cost, and the cost of goods sold account increases by that corresponding amount, or decreases by that corresponding amount, because we didn't spend as much on manufacturing overhead as we thought we would. Okay. So that adjusts our manufacturing overhead account for that over applied overhead. Our cost of goods sold account decreases by $87.50 because we over applied. So our cost of goods sold is that adjusted number. So go back and review. So what we would have applied, subtracting out that over applied overhead, that $87.50. That has to be the balance in our cost of goods sold account as of January 31st. Okay. All right, so now we need our inventory balances. So first we need materials inventory. Okay. So if all else fails, start at the beginning. So we go look at our beginning materials inventory. So remember, this is our first month of operations. Okay. So what's going to be our beginning balance in our direct materials inventory? Hopefully you said 0, because we couldn't have had any because we're just starting out. Okay. So the only thing that would be in there would be stuff we purchased. Clean this up a little. So we go back and look, and remember we had made we'd purchased materials for $800,000. Doesn't matter, it was on account, still goes in that inventory. Okay. So we used materials. Remember on those 3 jobs, 1001, 1002, and 1003. So we need to go and look at how much direct materials 1003 used. $100,000 on job 1003. So adding those up, we spent $750,000 on materials that we used up between those 3 jobs. Let's go ahead and make that a currency. Get those pesky decimals out of there. Tidy this up. So we purchased $800,000, we used $750,000, so the difference, and we started with nothing. So our beginning plus purchases minus what we used up. That has to be the balance. So our materials inventory for January 31st has to be 50 grand worth of stuff in there. Okay, direct materials, we need our direct labor and we need our overhead, because in part 2 we need our work in process inventory. So remember, all those production costs are going in there. So our first month of operations, so can't be a balance in there. Okay. So we know how much indirect materials we spent. Let's make these pretty here. So direct labor, we know how much in cost we had for 1001. Remember, it was $3,600. Direct labor, 5,400 for 1002. So we need to go back and look. Direct labor for 1003 was 1,350. Make that pretty. So all those added together have to be our total direct labor costs for all 3 jobs, so 10,350. Okay. So now our overhead. So our overhead applied to jobs 1001, 1002, 1003. Remember, we calculated that to $58,750. So now we transferred some of those jobs out of work in process. Remember, 1001 and 1002 got transferred. And so we calculated those costs right here. So that looks like 1003, but those are our costs here, remember, were these totals added together. So let's actually move this out here so that's a little clearer. So our total costs for 1001 is $543,600. And our total cost for 1002 was at $340,400. So our total for those being transferred were $884,000. Okay. So our work in process inventory has to be our direct materials plus direct labor plus overhead minus the cost that we transferred out. So there should be $135,100 remaining in our work in process inventory. Okay. So now finished goods. Finished goods is a little easier. 1001 and 1002 were the only ones transferred out of work in process. All right, so our beginning balance here again is easy. Format these. So it was 0. It's our first month of operations. So our cost of completed jobs. Move this out a little. So remember, those were 1001 and 1002. So our cost of complete jobs, remember, we already totaled those up, so $884,000. Now, the only thing that came out of finished goods was job number 1001 that we sold. So it's no longer in finished goods because we sold it. Okay. So the cost of job number 1, remember, cost of goods sold, is $534,600. Okay. So figure it out. Normally our beginning balance plus the cost of our complete jobs minus what we sold, because that's now, but those costs have now been transferred to cost of goods sold. We should have a finished goods inventory of $340,400. And I'm coming up with the wrong number because why? Hold on just a minute, technical difficulty, something's not calculating here. Not sure why Excel is coming up with the wrong number. Yeah, for some reason it's coming up with 9,000 and I'm not sure why. Oh, because, sorry, I transposed those numbers. So that should be $543,600. I was blaming an Excel and it was me. So there we go. Which is why Connect has check your work. So we knew something had to be wrong, so we gotta go fix it. All right. So now we know what should be in our finished goods inventory. 500 or 340,400 bucks. Okay. So now we've already determined this. Manufacturing overhead in January, was it overapplied or was it underapplied? We know it was overapplied by $87.50. Okay. All right. If you feel good about how we worked our way through this problem, Chapter 17 probably doesn't get a whole lot harder than this. So if you've got a good grasp, then I feel comfortable that you're getting everything. So hopefully this was helpful, and I will talk to you again soon. Bye.